What is Forex? Let's talk about that for a minute. So, Forex is just another word for currency markets. Now we have these two words, foreign exchange, that's what we call it, the foreign exchange market. Now from those two words, they grabbed a few letters and created this word, which is Forex. Now the currency market is just a global market where the value of money is negotiated. So it's a market where you can go and you can buy dollars, sell dollars, buy British pounds, Japanese yen, Canadian dollars, euros, the currencies that are available across the world. So by people buying and selling, we can discover the price of something. Now, the price of a currency is usually a direct reflection of the market's opinion about the current and future health of its respective economy. What does that mean then? Well, to give you an idea, right now when I'm recording this in February 2021, we're in the pandemic still, the COVID-19 pandemic, and the British pound has been gaining. Why has it been gaining? Well, it's been gaining because the UK government has been able to vaccinate a large part of their population, and it looks like they are going to be the first ones to be able to open and go back and have some sort of a functioning economy. And that means that people are betting on the British pound, and they're buying more than that they're selling, and the British pound is going up. Now, how big is the currency market? Well, you can see here the daily transaction. So the daily transaction is 6.6 trillion. Or as you can see here, how that looks like in billions. Compare that with the volume across all the world stock markets, which amount to 200 billion. That means that the currency market is about 33 times bigger than the world stock markets combined. Why? Well, because we use currency for imports, exports. But even when it comes down to stock trading, if you are a British or based in the UK, like I am, and you want to buy something like a Tesla stock or Apple stock, then I need to take my British pounds, sell them, and exchange them for US dollars and buy the stock. Of course, my broker would do that all for me, so I don't actually have to bother with that, but that's actually what's happening. And the benefit of having a market that is so big is that the cost of buying and selling is very, very small. So you have actually people trading 5-6 times a day, and they're still able to make a profit. Try to do that in another market where the liquidity is not that high, then you're going to find that the spread, which is the cost of buying and selling, is wider, and sometimes you even pay commission, which is very typical when you're trading stocks. Now, it's a bit different to a normal market because it's decentralized. So for example, if I want to buy certain American stocks, I need to go to the New York Stock Exchange. There they have the New York Stock Exchange trading system, and there they collect information of all people buying and selling, so they can see exactly what the daily volume is like. Everybody just goes to that marketplace, New York Stock Exchange. But when it comes down to currency markets, it's actually a market that is decentralized. That means that there's no specific market. So how does the trading actually happen then? Well, let me explain. Well, you have a broker, for example, like ATFX. Now, ATFX has liquidity providers. Imagine they have a top tier bank in the UK, and that UK bank provides them pricing. So what happens is that ATFX clients are buying, and ATFX will then transfer that position automatically to this tier 1 bank. Now imagine everybody's buying a lot of British pound that day, and the bank itself, they have a certain stock of British pounds, but they don't have unlimited stock. So if they see, oh look here, the stock of British pound is coming down now, then they need to go out and buy British pounds from another bank. So then effectively it used to be like this, old school, they used to pick up the phone and they would call. So for example, you have one bank, maybe HSBC, would call Barclays and say, hey Barclays, we want to buy some pounds. They're going to say, of course you can buy some pounds. And when they buy the pounds, usually the price goes up a bit. And then maybe Barclays find themselves with too little British pound, and then they would call another bank like Lloyd's Bank and do the same, and that way the price of the British pound goes up just because people at the broker ATFX started to buy. Obviously that's a simplified way of looking at it, but that is really what it is, a decentralized market where people effectively just calling each other and that way clearing out the any excesses, so when people buy too much or too little. Now what's quite neat with the currency markets is that it's open 24 hours a day, 5.5 days a week. So it effectively opens up, if you're in England, it opens up at 10 p.m. London time, which is the same as 5 p.m. Eastern, and then it's open from 10 p.m. London time and closes effectively at 10 p.m. on Friday London time. So you have like about 5.5 days of trading. Now, it's not that the market is active and busy throughout all of these days, because most of the activity happens during the European session. So effectively from about 6 a.m. London time until about 5 p.m. London time, you have a lot of market activity. After that, it dies out. But this is actually good because there's some people that prefer the less volatile Asian session. There's some people like myself that prefer the volatile European session, and then you have the US trading session, which is in the afternoon as well, because obviously the US continues to trade after London has closed. Now, the different type of volatility means that people have different sort of strategies, and that's great. And it's also used as an argument for people that are having a full-time job. So for example, people that are working 9 to 5, and then they come home and they want to trade, they could trade in the evening and they get a specific set of markets. So that's one great benefit of the currency markets. So it's not like stock markets where usually you have a specific session where you can trade stocks. Now, what are the participants in the currency markets? Well, you have central banks. So that would be, for example, like the Federal Reserve in the United States of America, the European Central Bank, and the Bank of England. These are just some 3 examples. And what happens is that they obviously monitor all the different commercial banks. And these commercial banks, they need to sometimes borrow from the central bank, and then the central bank needs to go to the open market. But more importantly, the central banks as well here many times help the treasuries of their own countries to manage their cash flows. So the central banks are big players, and they usually set interest rates, which is the price of borrowing money. They set the rates on those, and that usually has an impact on the actual exchange rate. You have the commercial banks, as I just mentioned. I mentioned a few names like HSBC, Barclays, Lloyd, like all the big banks operate in your country. It might be the biggest bank in your country that does the trading. And these as well, the trading financial markets, they help out with IPOs, the investment banks, for example. And then you have investment funds and hedge funds, which are professional vehicles where you have a professional trader that would manage people's money, and they dedicate themselves to buy and sell. And then you have individual investors, your typical retail client, which has a smaller account, and they want to create a second income stream, and some even want to replace the full-time jobs with trading. And obviously with the growth of internet over the last 20 years or so, is becoming a reality for more and more. A lot of people can effectively trade with help of their mobile or their desktop. And that, guys, is the currency markets. I hope you enjoyed this video. Don't forget to subscribe to our channel, and don't forget to like it. Press that like button. Thank you, and see you guys soon.